Good morning, everyone. With little economic data to move the markets yesterday, the main focus was increasing fears about emerging markets. Tensions in Ukraine continue to increase as German Chancellor Merkel reportedly called Russian actions in Crimea an annexation and said Russia must switch course in the region by next week or risk more sanctions. The EU will discuss harsher sanctions on the 17th of March, the day after a planned referendum in Crimea on whether to join Russia. Sanctions on Russia would no doubt be met with counter-sanctions. All in all, they'd be a big negative for global trade and global growth. At the same time, China is also troubling the markets. There were rumors that yet another Chinese solar company would announce a default. These rumors, while unconfirmed, affected the commodity markets, and copper fell further, dragging the Australian dollar back down below the 90 handle again with it. The Australian dollar was the worst performing G10 currency as risk aversion came back into fashion, while the flip side of that trades, the safe haven yen, was the best performing one. Otherwise, the dollar was surprisingly was almost unchanged against the other G10 currencies compared with yesterday morning's rates. On the other hand, the greenback gained against all 15 emerging market currencies that we track, led by the South African rand. Now, the collapse in copper prices pushed oil prices down as well, and the rout in commodities dragged U.S. stocks with it too. The slowdown in Chinese growth is causing oil demand there to slow and increasing the amount of Chinese exports of refined products, as they can't sell them domestically, so they try to export them. That's depressing oil prices globally. I expect the tensions in Ukraine will only increase as the referendum approaches, while the unraveling of the Chinese credit bubble is just getting started. So I think these trends are likely to continue and, in fact, likely to intensify. The Australian dollar seems the most vulnerable currency to me. After that, CAD, the Canadian dollar, is also vulnerable as oil prices start to be dragged down with metal prices. Now, the Swiss National Bank's intervention means that the yen is likely to respond more to safe haven demand than the Swiss franc. So, in my view, Aussie yen would be one way to play the slowdown in the Chinese economy. Today, there's nothing major on the indicator schedule. There is a conference on the ECB and its watchers where several ECB board members will speak and presumably be watched too. Then overnight, the Reserve Bank of New Zealand is going to have its monetary policy meeting. This should be a landmark meeting, as the RBNZ is expected to be the first G10 central bank to raise rates during the current cycle. It's widely expected to raise its official cash rate by 25 basis points to 2.75%. In fact, even after that, another rate hike is within the year is already priced in. So given the widespread expectations of a hike, the response of the New Zealand dollar depends on what comments Governor Wheeler makes following the meeting and how quickly and how far he sees the rates rising. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, Global Head of FX Strategy at IronFX Global, wishing you solid trading.